What happens to your investments when the U.S. government shuts down? The headlines always sound dramatic, even scary. But the truth is, the real impact is often different from what you see in the news. Government shutdowns are not new. In fact, since 1974, the U.S. has gone through many of them, some short, some lasting weeks. Each time there's a lot of noise, but history gives us a clear picture of what actually happens. So before we let the panic take over, let's break it down step by step. First, let's make sure we understand what a government shutdown really means. A government shutdown happens when Congress can't agree on new spending bills. Without that agreement, funding for many government agencies simply stops. Now, this doesn't mean the entire government shuts down. Essential services like the military, Social Security checks, and Medicare payments continue. But hundreds of thousands of federal workers are furloughed, meaning they're forced to stay home without pay until the shutdown ends. Each one brought different levels of disruption, but the pattern is clear. The longer it lasts, the greater the impact. So what does this actually mean for the economy and for you? Let's look at the immediate economic impact. When the government shuts down, the most visible impact is on federal workers. Hundreds of thousands are furloughed, which means they're not getting a paycheck during that time. Now, eventually they do receive back pay, but in the short term, this creates financial stress for families and slows down local spending in the communities where they live. On a bigger scale, shutdowns do weigh on economic growth, though usually just a little. If it lasts long enough, GDP growth might slow by a few tenths of a percent. For example, the 35-day shutdown back in 2018 to 2019 cut quarterly growth noticeably, though the economy bounced back after it ended. So yes, the impact is real, but it's usually not enough to derail the overall economy. Now, the next question investors always ask is, how did the markets react in the short term? Let's talk about that. When a government shutdown hits, investors often move into what we call a risk-off mode. That means money flows into safer assets like treasuries, gold, or just cash. You'll usually see the stock market wobble a bit, maybe a small dip here or there. The key takeaway, history shows these reactions are generally minor and temporary. And here's an important point. It's not the shutdown itself that rattles markets, it's the uncertainty around it. So while it might feel unsettling in the moment, it rarely signals a long-term market crisis. That said, if a shutdown lasts longer, there are other economic effects we need to consider. Let's take a look at the longer-term considerations. If a shutdown drags on, it can slow down government payments and contracts, which may ripple through certain industries and projects. Consumer confidence can also take a hit, as uncertainty tends to make people spend more cautiously. Another important effect is the delay of key economic data. For example, jobs reports, inflation statistics, retail sales, and consumer sentiment surveys could be postponed. For investors, these reports are crucial for understanding the health of the economy and guiding decisions, so delays make it harder to assess the market in real time. While short-term market reactions are often modest, these longer-term factors can subtly influence sectors and assets, which brings us to the next point: which areas are most affected? Companies that rely heavily on government contracts like defense contractors or other federal suppliers often see a short-term slowdown. Tourism and businesses around federal sites, think national parks and monuments, can also take a hit. I remember during the 2019 government shutdown, I visited a national park I'd planned months in advance. Many visitor centers were closed, trails were unstaffed, and local hotels reported fewer guests. It really brought home how even a short shutdown can ripple through local economies. Interestingly, during these periods of uncertainty, treasury bonds usually become more attractive. Investors flock to safety, which can temporarily push yields lower. As for the stock market overall, dips caused by a shutdown are often short-lived. If you're focused on the long term, these moments can sometimes present buying opportunities rather than signals to panic. So, now that we understand where the impact is most visible, let's move on to what this means for you as an investor. The key takeaways and strategies you can use to navigate these events. First, don't panic. History shows that the effects of government shutdowns are usually temporary. Second, maintain your diversification. It's your safety net in uncertain times. Third, if you're a long-term investor, see the short-term volatility as an opportunity rather than a threat. Finally, keep an eye on secondary effects. Delayed economic reports can influence Fed decisions, earnings season narratives, and overall investor sentiment. By keeping these points in mind, you're better positioned to navigate the uncertainty with confidence. And speaking of confidence, let's wrap up with some final thoughts and a clear takeaway for your portfolio. So, to wrap up, government shutdowns may sound dramatic in the headlines, but for investors, the historical impact has generally been modest and short-lived. From my perspective, shutdowns aren't a market crisis. They're more like a test of investor patience. Staying calm, maintaining a diversified portfolio, and keeping a long-term view is usually the smartest approach. If you found this breakdown helpful, please hit like, share your thoughts in the comments, and subscribe for more insights on how major news events can affect your investments. And if you're interested in taking this a step further, check out my previous video, Investing Guide for Every Life Stage, where I break down strategies for building wealth at every stage of life. Thanks for watching. Let's together make better financial decisions.